Hello, this is Asa Graves of Graves Light Lenhart. We are changing the format of our formal quarterly client communication. Instead of a written report, we are providing this 10-minute video summary highlighting the main points of a more detailed chart pack which accompanied the link to this video. Our intention is to communicate what we see and how our management of client portfolios may change in response. Our hope is that our clients will feel more comfortable with their investments and will engage with us to discuss their needs and/or concerns. Please let us know what you think about this new method of communication, along with suggestions to make it better. The main points of this presentation are: 1. We expect the markets to remain volatile as investors react to recession fears, inflation trends, and worries about the banking industry. 2. We continue to prefer investments in value and small cap stocks, even though both underperformed during the first quarter. However, international stocks outperformed. 3. We like the risk-return trade-off of shorter-term bonds. 4. Targeting desired market segments has become more difficult due to index updates. And 5. We intend to maintain our current investment posture, but we have our eyes fully open and will adjust if necessary. The performance of various segments of the overall stock market during the first quarter were largely a mirror image of their relative rankings during 2022. Large tech stocks enjoyed strong performance during the quarter, with a handful of stocks accounting for the vast majority of the S&P 500's gain, as shown in the return breakdown in the chart on the lower left. Domestic stock winners over the quarter were characterized by higher valuation, lower dividend yields, and more volatile stock price and earnings trends. International stocks, as denoted by the EAFE or EAFE index, achieved strong quarterly returns which were close to those experienced by the large growth stock index. Bond returns continued to rebound from 2022's historically bad decline, while commodities weakened over the quarter. Recession fears are prevalent throughout the media. Our position is that the risks of a recession have increased due to the combination of the Federal Reserve's monetary tightening program, enacted through raising interest rates and liquidity reduction, geopolitical conflicts, the length and depth of the inverted yield curve, where short-term interest rates are higher than longer rates, which retards credit availability, and the likely aftershocks resulting from the recent stress within the banking industry. However, the near-term economic indicators look okay so far, even with the sharp moderation over the past 2 weeks or so. The chart on the left of the page shows the Atlanta Fed's GDP Now estimate, which is based upon the economic statistics released so far during a given quarter. The GDP Now estimate is currently tracking at a 1.5% annualized growth rate for the first quarter, which is slightly below the projected 2% long-run estimate for the United States. The chart on the right of the page shows the forward-looking 12-month earnings per share estimate for the S&P 500 has stabilized, as shown by the dark line. Economics has earned the moniker the dismal science, as forecasts rarely catch the turn in economic cycles. The same goes for security analysts in regards to their EPS projections. Interestingly, economists and analysts currently have contradictory forecasts, as shown in the graphs on the left side of the page. I appreciate that focusing on the intellectual jiu-jitsu of the competing camps may not seem compelling, but the winning side will likely have a material impact on future security prices. Currently, we feel that the turmoil within the banking industry will likely be more of a brush fire than a forest fire, but we will only know in hindsight. Historically, financial crises have a mixed record in terms of forthcoming recessions and/or bear markets, as shown in the table in the upper right. However, the Fed has often begun to cut interest rates a short time afterwards. At present, inflation appears to be moderating, with a number of forecasters calling for annual inflation run rates of 2% or so by fall. While possible, as shown by the lower end of the historical ranges in the charts on the bottom right of the page. Such moderation from high inflationary conditions would track more of the exception rather than the rule. If inflation does not moderate to an annualized run rate of 3% or so or lower, markets could be vulnerable. If inflation doesn't moderate as hoped, the Fed will be forced to keep interest rates higher than expected, which will increase the odds of a recession. If a recession does occur, it is likely that the S&P 500 will challenge the October 2022 lows, which represented a 25% decline from the January 3, 2022 all-time high. To put this into context, the typical post-World War II bear market has fallen more than 30%, as shown on the table to the left. The charts on the right-hand side of the page show the typical bear market experience has been both longer and deeper during an associated recession. We do not profess an ability nor intention to try to time the market to avoid such an outcome, and it's not because we aren't aware of the danger. Rather, it is a result of the well-documented futility of trying such actions, as one must make well-timed sales and well-timed subsequent buys. Our approach is to control what we can and focus client portfolios on securities with less demanding valuations, which should be able to better ride out the storm as well as benefit during the subsequent bull market cycle. As stated earlier, the relative performance of many equity market segments have been the mirror image of their respective 2022 experiences, highlighted by large cap tech stocks enjoying strong performance over the past several weeks. Nonetheless, we remain focused on stocks with less demanding valuations and therefore expectations. It would be much simpler if market positioning enjoyed consistent historical analogs, but spreadsheets and models don't represent real life. In fact, the best long-term periods often have sharp counter-trend rallies along the way. For example, value stocks enjoyed their best 3-year period of outperformance following the bursting of the dot-com bubble. However, investors needed to grit their teeth throughout 4 of the 10 worst monthly periods of underperformance along the way. The takeaway is that value stocks have often experienced superior performance during challenging market downturns and the following uptrend, but the return pattern itself has been volatile. We remain positive on the long-term potential of small caps, which continue to enjoy unusually low valuation relative to both large cap stocks and compared with their own historical ranges. Of note, financials make up roughly 16.5% of the S&P 600 small cap index, but that includes banks, insurance companies, and other related industries. Of note, small banks have increased their exposure to commercial real estate over the past few years, which represents an ongoing risk. Nonetheless, we are comfortable with the well-diversified nature of these holdings within the S&P 600 small cap index. We have been increasing our clients' exposure to bonds and remain focused on maturities of 5 years or less, with a particular focus on 3 years or shorter, due to the competitive yield to maturity opportunity with less interest rate risk. We often say that high-quality bonds are essentially math equations, as the starting yield to maturity, which is largely driven by the purchase price, provides a strong indicator of the future annualized return received through maturity, as shown by the linear relationship on the graph. Active management is hard, but even passive or index-based investment has become more complicated. In December, S&P made major changes to the value and growth components of the S&P 500. Of note, Alphabet, also known as Google, Amazon, Meta, also known as Facebook, and Microsoft gained inclusion into the Generalized Value Index. For example, the price to earnings or PE-based valuations of the growth versus value sections of the S&P 500 have narrowed considerably. A broader view of value-based characteristics continues to show value stocks meaningfully undervalued to their more popular growth cousins and largely near the middle or lower half of their historical ranges across various valuation metrics. We have analyzed and selected appropriate investments to maintain our desired targeted exposure. Thank you for your time and interest. We hope you found this presentation useful and that you are more comfortable with the positioning of your financial assets. Please let us know if you wish to discuss these or any other issues. We are here to help.